That's a very common mistake that we see.
I think that would surprise a few people. Now, are there a lot of investigations of expats?
They're actively using AI to pull out and track data. Rather than having a $23,000 tax bill here, they could have had a zero.
If you're planning to move to Thailand, you've probably seen the headlines. Changing tax rules for foreign earned income, savings, or pensions. And there's a lot of noise online. But if you get this wrong, it can cost you a lot of money. So today I'm going to sit down with somebody who deals with the topic each and every day. I'm here in Bangkok with Carl, a tax accountant who works with retirees, digital nomads, and expats more broadly. And he's going to answer some questions about the whole tax situation here in Thailand. Welcome, Carl.
Thank you. Yeah, thanks for having me. I'm happy to help.
So why is tax such a confusing topic for expats?
Yeah, good question. I think the main reason is a lot of people are seeking advice from online forums and from things like ChatGPT, rather than from the revenue department or companies that actually work closely with the revenue to explain the rules clearly. So we've got a team of Thai accountants, Thai lawyers that actually provide the advice and actually do the tax filing. My job is to liaise with expats so they can understand the rules clearly, so it's simple for them to understand. And to be honest, the new changes to the rules that have been in place now for 2 years is pretty clear and it's pretty transparent how it works in practice. And the revenue have done a really good job to actually explain this and make it clear for expats what they need to do if they remit foreign sourced income. So I think the reality is it's people are not looking at the right sources rather than it's confusing from the revenue. They've actually done a good job to explain it. If you remit foreign sourced income and you're a Thai tax resident, it's assessable income in the year that you bring the money in. So before there was this 1 year loophole that if you left it overseas for 1 year and you bring it in the next year, it's not assessable income. That was based on one private ruling. And what they did is just overrule that private ruling and go back to the original rules. So the rules are from 2024. If you remit the money in from 2024, if you're a tax resident, if you remit foreign source income into Thailand and it's earned since you've been here, since 2024, then it's assessable income in the year that you bring it in. So let's say you earn money, let's say you've lived here for a while and you get a pension overseas and you earn in 2024 and you decide to bring it in this tax year, 2026, you have to file for that income in the year that you bring the money in. So there's no longer this loophole, which is fair, which moves towards the OECD standards internationally, so that it aligns with other countries as well. So let's start from the basics. So who needs to file a tax return and what do they need to actually do? So there's 2 reasons why you'd file a Thai tax return or you've got assessable income. The first one is if you've got domestic income. So what does that mean? It means things like if you've got rental income or you've got a salary here in Thailand, or you've got a lot of bank interest, for example, then you need to file a Thai tax return, regardless of the amount of days that you stay in Thailand. So even if you're not here, if you've got domestic income, like most other countries, you need to file a tax return for that income. The second part is regarding foreign source income. This is the confusing part where expats get quite, there's a lot of bad information online. And this all is down to tax residency. So it's not down to the visa, it's down to how many days they've stayed in Thailand in a calendar year. So Thailand works on the calendar year basis. So 1st of January to 31st of December. If you are 180 days or more in a calendar year, then you are a Thai tax resident, not consecutive, just throughout the year. And you're a Thai tax resident from the 1st of January. So even if you moved in March, doesn't matter, you're a tax resident if you meet 180 days in that year from the start of the year. So it's a very important part to consider. So let's assume that you're a Thai tax resident, so 180 days or more. Then what we look at is, did you remit foreign source income? Now, what does that mean for everyday life? Remittance means transfer to a Thai bank account. That can be your bank account or spouse, partner, school, can be the landlord. It doesn't matter, it's still your remittance. And also if you withdraw from an ATM machine, cash machine, that's also remittance. And also if you use Visa, MasterCard, debit card here, that's remittance. So remittance means many different things. It's not just what a lot of people think, transfer to their own Thai bank account. It's all these other areas. So now we know 180 days or more you're a Thai tax resident. We understand what remittance means. Let's go on to the third thing, which is foreign source income, which again is quite confusing. Now the Revenue Department has a clear list of what is income, what's foreign source income. So these are things like, let's say you get a salary overseas, or you've got a pension income overseas, or you've got an investment portfolio overseas and you disinvest and you've got investment capital gains that you've brought in, or you get dividends, for example, or rental income overseas. If you bring any of these sources into Thailand and you meet the criteria, so 180 days or more in that year, and you remit to your bank account, another bank account, withdraw from the ATM, and the source of that money is any of that foreign source income list, you have to file that on a Thai tax return. So that explains a little bit on there. It's a bit long-winded, but I think it's quite useful for people to understand what it actually means. And the reality is not everyone has to file. You have to meet the criteria of domestic income. Fine, you have to file if you're over the minimum requirements, which are really low. 60,000 Thai baht for rental income, for example, if you're single. And if you bring in foreign income, then in most cases, if you're here 180 days or more, you need to file a Thai tax return. Again, the limits to file very low. 60,000 Thai baht for investment capital gains, for example, if you're single. If you're married and you've got a pension, it's 120,000 Thai baht. So it's not much before you have to file. There are some things in the Revenue Code that's not assessable income. Okay, so that's the key, is what isn't assessable income. And this, again, there's a lot of confusion with this. You know, Thailand's very fair in terms of you're only taxed on a remittance basis what you bring into Thailand in most cases. But also you can choose what you remit into Thailand. So you know, if you have a lot of cash in the bank from many years ago, from before you moved here, for example, and it's still in cash or a money market fund or T-bills, for example, that in most cases, if you remit that, is not assessable income, depending if there's any gains on there. For example, if you receive an inheritance, and the inheritance is in cash, not if you receive a property, but you receive inheritance and you remit that in, then potentially that's not income. So there's certain things that are not income and certain things that are. Let's say you pay tax on your investments, for example. Let's say you're a Canadian tax resident still and you receive investment capital gains or dividends and you're taxed in Canada still and you bring that money to Thailand. Then you can use the tax paid in Canada as a tax credit here. And also some other things like, for example, US Social Security is tax exempt. So it's not everything that you bring in is taxable. Let's explain what double taxation agreement is first, because that's confusing as well. So there are 61 double taxation agreements signed with Thailand. There are some other countries like Slovakia that have signed an MOU in November last year, so there are more going to be added. And what this means is there's a set rules in the double taxation agreement to show how certain assets are taxed in both countries. And there are things like US military pensions that's clearly stated in the US-Thai double taxation agreement that it's only taxable in the US. So government services, civil service, federal pensions are only taxable in the US. They're not taxable in Thailand if you remit those funds. They are exempt. Yeah. Also, let's talk about Canadians. This might be useful, is Canadian pensions are exempt from tax in Thailand. They're only taxable in Canada, for example.
So what are the typical problems that you encounter dealing with clients, dealing with the Revenue Department here? What are you seeing most often?
Yeah, so one for our Thai accountants that actually do the tax returns, they come to me with mistakes that they see again and again and again. And a lot of the time, that's when I get called in to help explain what they've remitted in or what mistakes they've actually made. So the common things that we see are people not realizing that if they use their ATM card or Visa, MasterCard, that's remittance. So a lot of people just think it's transferring money to their own Thai bank account, not thinking about everything else, spending to spouse, sending to partner, sending to the landlord, for example. That's all remittance. That's a very common mistake that we see. Some of the other things that we see are people that they have a commingled bank account overseas. What does that mean? It means they get different income sources. Some are tax efficient, some are not. And they think they're sending only US Social Security to Thailand, but they're not. Because when we look at the bank account overseas, we can see under first in, first out principle for how we look at what was brought in, they actually brought an inefficient income source in, and it wasn't necessarily what they thought. Or they've got cash savings in account A, but they sent money from account B to Thailand. And they say to us, it's pre-savings. But when we actually look through the documents, we have to see the paper trail for exactly what came into Thailand. And nothing ever came from account A. So they didn't use their pre-savings. They used the wrong account to send the money. So they can have tax implications where they thought, their overall wealth was, they had a lot of savings, but the reality is that's not where they sent the money from here. So it's a very common problem that we see again and again. And it can have serious implications if they don't understand the rules. People act before they seek advice, before they understand the rules. And then we're left to tidy up the mess, to work out how much tax they have to pay. And then they realize that they've remitted the wrong source or an inefficient source, and they've got tax to pay here, even if they've got tax credits from overseas. So I'll give you a good example for this. We met with a couple maybe a year and a half ago in Thailand. They're from the US, and they had a 15-minute meeting with ourselves. And what my colleague said, he recommended that they had an hour consultation because they had a complex situation and they wanted to send a big amount of money to Thailand to buy a property. And they need to really choose what income source they remit in. They had many choices because they're not all taxed the same. And they decided not to seek advice, and they just acted. And they sent across something. And the reason why we found out is we filed their tax return. So at the end of this year, so 2025 tax year, we filed their tax return. And what they'd done, they sent 15 million baht across from investment capital gains in the US. So what they'd done is they disinvested stocks that have performed really well with long-term capital gains. So they had Tesla, Apple, they held them for years. And they had large capital gains. Pretty much all of what they sent across was a capital gain. Now the problem for this is, for US, they'd already been taxed on this money. But because they sent across so much, and the majority was investment capital gain, in Thailand, all of that money gets added to their income here. So they had a lot of money that went into the 35% bracket here. And obviously they paid less tax on that money in the US. So when we did the tax return, when the Thai accountants did the tax return, we claimed the tax credits, but they could only claim about a third of the money that was due here. So they had nearly 700,000 baht tax to pay here, so 23,000 US dollars on top of what they already paid in the US. And they said, why am I getting double tax? Well, you pay the higher of the both. So you've got to be really careful, because rather than having a $23,000 tax bill here, they could have had a zero, because they had a lot of cash in other accounts, they had inheritance in another account, they had money market funds, treasury bills, they had many different assets, but they brought in the wrong source, and it meant that they had a big tax bill. So people that act without seeking advice or understanding the rules is the biggest problem that we see. It meant they had 12 million baht plus of capital gains that they brought in, which means that the majority of that goes into their income, and that's taxed a lot in the higher brackets. So when you compare that to the tax they paid on that in the US, there's a big tax gap and it meant they had to pay the difference here. The outcome for that could have been for an hour consultation with ourselves or another company, right? It doesn't matter where they get the advice from, that's not the point. The point is if they understood the rules and understood what they could bring in, they could have got that down to zero. One problem that we're seeing more and more is people that are using LLMs to, ChatGPT type applications to research and find the information. Now the problem with that is it doesn't produce the up-to-date information. 2, it will pull out old information as well. And 3, it will pull out incorrect data sources. So people got to be really careful where they get their information from and make sure it's from a credible source that actually work closely with the revenue department to actually explain the rules clearly.
When it comes to general advice, somebody who's living in Thailand now, somebody who's planning to move to Thailand, is there a set of tips, checklists that you could say, okay, this is how you're going to want to set things up, or just think about the entire tax situation?
Yeah, good question. So my top tips are people should keep a very good record, and the record keeping is the most important, of exactly what they've remitted, transferred into Thailand, and the source of that money. That's the most important part. What did they bring in? How much in Thai baht? And what's the source of that money? Is it rental income, salary, dividends, pension? Because they're all taxed differently. So they need to keep a very good record and track record of the flow of money to Thailand, whether that's transferred to a Thai bank account or used on Visa, debit card, or MasterCard, for example. We need to see exactly what was spent here and what's the income source. And they need to keep that on file ongoing, because you can be looked back. The revenue department can assess up to 5 years. If they feel you've been fraudulent, they can look back 10 years. So record keeping is the most important part. And it's really important that people keep this on record in case they're ever asked.
Carl, what's the biggest mistake that you see retirees make that are planning to move to Thailand before they actually make the move?
So the biggest mistake that we see from people that are looking to move to Thailand is not preparing before they move. So the year or so before they move is so important to set things up so they've got an easy life here in the Kingdom of Thailand. So it might mean things like restructuring what assets they've got already overseas and preparing for what they're going to live on here, whether they're going to bring money in to buy a property or whether it's just for income. They've got to really understand, is the visa they're going to apply for suitable? What's the sources of income they're going to use to bring in? Because some of the mistakes we see is they've not prepared and they sell the property in the year that they're already a tax resident, for example, and they've got a big tax bill here. Or they disinvest an asset overseas, whether that's in US, UK, Europe, Australia, and it's inefficient for here. Whereas if they planned the year before, they could have set things up and made it very tax efficient to live here. So it can be tax heaven, or it can be in certain situations tax hell if they don't plan properly. So that's the biggest advice that I think before they move, they should seek advice from any company that specializes in cross-border advice so that they can really understand what assets they've got, what the implications are for those in Thailand. Is there anything they could do before they moved here to set it up in a way that's sufficient for living here long term? So we get a lot of people that say the money that they bring in for the visa, 800,000 Thai baht or 400,000, whatever the amount is, for depending on their visa type, we get a lot of people saying, well, I've brought that in for the visa, why should that be assessable income? That's irrelevant. For Thai Revenue Department, it doesn't matter what the purpose you bring the money in for, buy a property, pay to the school, use it for your visa. It's the most important part is what's the source of the money that you brought in and how many days have you been here? That's the most important part. Are you a Thai tax resident? Is it foreign sourced income or not? Rather than what the purpose of bringing the money in for is. And with retirees, if they are having to remit money in on a monthly basis for their visa, then they've got to look at if they're bringing in pension, do they need to file for that or not? What's the amount that they've brought in? If they pay tax overseas, can they use tax credits? So there's a fair bit to look at it for retirees. it depends what they bring in, so if they need to file or not.
So when we're talking about the source of an income, if I have a single bank account, say I've got a bank account in Canada, but I get multiple different sources of income into that bank. I have a salaried income, I get paid dividends, and they're all linking back to the same account. How would the revenue department treat that? Which income would they assess?
Good question. It's up to you to inform on your tax return what you remitted in. So the record keeping's got to be spot on. So what you've got to do with we call that a commingled bank account where you've got multiple income sources. How we assess those bank accounts, we have a very good process to actually do bank reconciliation using first in, first out method. So every dollar that's in your account, we can tell exactly where that money came from using first in, first out principle. So whatever you send to Thailand from whatever account, we can assess and tell you exactly where that came from using the method that we use with first in, first out. So it's really important that people keep a good record. If they've got a commingled account, they can tell exactly what came in and from what source. Is it pre-tax residency savings, or is it foreign source income, or is it a tax exempt income or not income at all? So it depends on what's in that account.
So would I be able to choose, say I've got like these 5 different streams that go into that one account. Am I able to say I'm moving $20,000 that are straight savings?
Yeah, it's a great question, and the answer is no. So simply, it's more complicated than that. You can't choose. It literally goes off the documents and the transaction history to exactly what dollar you are sending to Thailand. You can't choose at all. So we get that quite often, that people say, well, I'll just choose it's from dividends. You can't do that. It's literally off what came in and when, and then what came to Thailand. What was the account balance at the time, and what assets was in there. So it's reasonably quite straightforward for us because our Thai accountants are on the ball. They can do the analysis. For individuals, it can be quite painful to go through.
So the first income source into the account would be the first income source out of that account.
Well, also, let's think about this. Let's complicate things a little bit. Let's say you've been here forever, been here for a long time, then the rules changed in 2024. So you might have some money in that bank account that's under the old rules, the pre-2024 cash in the bank, to take that into account if the money's still in there. But let's say you moved this year, 2026. Then we look at the account overseas and your account balance at the end of 2025, because you weren't a tax resident here, that's not assessable income, it's pre-tax residency savings. So it can be a bit more complicated than this, but it's important that they can seek advice. There's many companies here that can help you do the analysis and work to see what you are spending.
And commingling sounds like it's a little bit riskier than maybe partitioning accounts and saying, hey, plan ahead of time, partition your accounts. Now you know exactly where the source of income comes in, and you're not going to encounter a surprise when you actually file.
Well, the good thing is, if people can plan what would be ideal, it's not right for all situations, that if you have different income sources, they all go into a sub-account or different account. So you can clearly demonstrate, if you want to send, let's use the US example, military pension or US Social Security, and you send from account A, and that's where the only source of money that goes in is from, you can clearly demonstrate with documentation to the Revenue Department, if asked, that this is tax exempt income. Same if you've got other income like an inheritance of cash, for example. If that went into one account with nothing else in there, and all you use is that account to spend in Thailand, you can easily demonstrate where the source is from. So if people really want to have an easy life here, a bit of planning goes a long way to make it simple, that you don't have to do this reconciliation every year to see exactly what you brought in.
I think that would surprise a few people. They wouldn't realize that. I certainly didn't realize that, so it surprised me. Say we're taking the US as an example. What tends to be the most preferable remitted source.
Okay, yeah, clear. I understand. So what's the most efficient to remit into Thailand? It all depends on their situation, but the reality is if you talk through what's tax exempt, so US Social Security, federal government pensions, civil service pensions from any country, this is tax exempt. So that should be the first income source that people remit in most cases because it's only taxable in the other country, not here. That's a good way to look at it. And then depending on the country, if you've got an asset, if the double taxation agreement allows you to claim tax credits and you've paid a lot of tax in the other country, that might be an efficient one to bring in. But you've got to do the assessment because not everything's equal. It depends on that jurisdiction and your circumstances and your other income sources as well here.
So like savings would probably be a decent one if they're from a prior income, because that would have been subject, say in Canada, if I make over $100,000 a year, I'm paying 30%. I'm probably going to be pretty well aligned with the Thai tax on that particular income. Yeah. Whereas say something like dividends, capital gains would be substantially lower in most Western countries than how it's treated as an income here.
Potentially, it depends on what other income you've got here or brought in and how much tax you've paid overseas. So there's a lot of factors at play with this, but in general, yeah, it might be more efficient to bring in the assets that have been taxed heavily overseas, depending on the double taxation agreement. So for example, we've got over 12 hours of long form video on YouTube for specific double taxation agreements because there's a lot to it. So all the major countries are on there and we do more all the time. So we bring in an expert from that country to explain how this works in principle. So yeah, if you want to view more about double taxation agreements, that might be a good starting point to view some of the 1 hour conversations about each of the different DTAs that we've researched.
If you want to learn more about your specific examples, you can check out Expat Tax Thailand and you'll get far more information.
So with our company, what we've done is partner with Learning Institute for Everyone, and we produced the annual tax guide for expats for Thailand. So we work closely with one of the Thai universities to put together this guide, which explains all of the rules for taxation that expats find useful for 2025 and for the new 2026 tax year. So if people want to download this, they can from our website. It's free to download. All the information's in there to explain what the current rules are for 2026. But the reality is, even though there were quite a lot of rumors with changes, it's the same. Yeah, it's a good starting point, very good starting point.
What are digital nomads getting wrong about taxes in Thailand?
Yeah, okay, so we deal with a lot of people on DTV visas. And the problem what we've got with the DTV visa is a lot of them, they can't open a Thai bank account. So they use a different account overseas to spend here for ATM withdrawals or Visa, MasterCard transactions. And what a lot of people say to us to start with is, well, I don't have any Thai income and I'm only spending on my overseas card. I don't have any assessable income. Well, that's not correct, because even using the ATM withdrawals or debit card here, if the source of the money overseas is income, like dividends, for example, or they've got investment capital gains, and they spend that money here, and they've been here 180 days in that calendar year, then they need to file for that on a Thai tax return, regardless if they've got a Thai bank or not, and regardless of the visa that they're holding. So it's really important. And, for example, some people can claim tax credits depending on where their income's paid, and some people can't. So it's really important that they look at what they're spending here. Is it more efficient to spend the dividends? Have they got savings that they could spend instead? Or have they got a different income source that's taxed higher that they should spend? So they can choose what they spend here if they can show the paper trail. But it's really important that they understand, just because they've got a DTV visa, it doesn't mean that they are exempt from tax in Thailand. They're treated the same as Thai person or anyone with any other visa. If they're here 180 days or more, they're a tax resident. If they remit foreign source income and spend that money here, and they're a Thai tax resident, they have to file Thai tax return. Quite a lot of the DTV holders, we get comments to say, well, they're a tax resident somewhere else and they already paid tax there, so they don't need to file here. Well, that's not correct. It doesn't matter if you're taxed on that money already. If you remit the funds into Thailand, let's assume that it's salary or dividend, for example. In most cases, they have to file that on a Thai tax return, even if they're spending on their Wise card or whatever they've got. Doesn't matter. It's still assessable income in Thailand.
When we talk about the tax liability based on days in the country, so you're in the country 180 days plus you're a tax resident, what happens if somebody does not spend 180 days anywhere?
Yeah, I'll give you a good answer. It depends, and it depends on your nationality and what tax residencies you have overseas, for example. So for Thailand, if you're at less than 180 days, you're a non-tax resident. That's the main criteria for here. So then we look at the domestic income in most cases, right? But if you do have, say you work here, that's different, right? But if in most cases, if you're less than 180 days or more, you're not a tax resident for here, you can remit funds into here and it's not assessable income. But before you act, you're better to seek advice and look through it, because in some cases you may have to. Then it depends on your nationality. So some countries want you or expect you to have a tax residency elsewhere, somewhere, or they drag you back in the tax net. Some countries, it's slightly lower to be a tax resident, so it really depends on your nationality. For example, Australia, they try and drag you back. Canada can drag you back.
They drag you back.
Yeah, for the UK, they don't. So in most cases, it's again about the amount of days that you're in the UK. So it depends on your nationality. If you're American, tough, you pay anyway and file in the US. But the reality is, there's a lot of factors involved with this. It's not as simple as what some people think is, I'll just be a digital nomad and remain nowhere. That's changed. Now a lot of governments have serious fiscal problems. They're looking to increase their tax base and they're actively chasing people to make sure that they're a tax resident somewhere, or they drag you back in the net. So a lot of people here want tax residency certificates to be able to show to countries like Spain, Israel, other countries that they have a tax residency, so that they don't get dragged back in the net for tax in their home country. So it's really important, if people are going to do this digital nomad route of not being a tax resident, to understand it's more complicated than it looks.
Now, are there a lot of investigations of expats? Are the Revenue Department actively investigating expats around failing to file taxes? Because one of the things that I would immediately think of is there's probably a lot of older expats who simply would not be up to date or aware of rule changes that keep bringing in their pensions, that keep bringing in the foreign sourced income and never bother even filing a tax return. And what happens in these situations?
Yeah, good question. So the major changes that were announced in 2023 for the 2024 tax year onwards. And there are a lot of expats that have lived here for a long time that have never really thought about tax filing in Thailand. Now, the difference between now and say 15 years ago is now that Thailand is part of CRS, Common Reporting Standards, which they actually signed up to in 2020. And the first time they received data was 2024, is now they're completely plugged into other revenue departments overseas. So they received the data, let's say for example, your situation. If you've got accounts in Canada or UK or Australia or anywhere in the EU, then every year those revenue departments send the information for all tax residents in Thailand to the Thai Revenue Department for all of your accounts, whether that's pension accounts, investment accounts, trusts. They received the information of account balances and any income that's been received in that year. So the data that they receive now, compared to say 10, 15 years ago, is immense. And Thailand's invested quite heavily, the Revenue Department, in AI to actually pull out data from inbound remittance. So they can see exactly through the Bank of Thailand what was sent to each bank account and who sent the funds. So the data that they have on hand is a lot more impressive now compared to, say, 10 years ago. And it's not that expats are being targeted at all. That's not the case. This is the same rule for Thais as well. So if Thais have got overseas income and they remit that, it's the same rule. They're treated exactly the same. They've set up a new department, the Revenue Department, for inbound remittance. They've hired last year over 750 new staff to look at inbound remittance. And they're actively using AI to pull out and track data. So it's really important that people comply with the rules. But the reality is, it's quite simple. And if they follow the rules, they've got no problem at all in Thailand. So if there is an active assessment from the Revenue Department, they can put a block on passports to leave the country or enter the country. I mean, this is extreme if they are assessed and they don't reply and don't work with the Revenue Department. But, you know, they can freeze passports for exit or entry into Thailand. And also it can be criminal issues, and they can affect visa status as well. But they're extremes. For most people, they don't need to worry. They just need to comply with the rules. If people feel that they didn't file correctly for 2025, 2024, they can volunteer and do back tax filing and rectify the tax return. It's easy and simple to do. And if people are worried about this, you know, you can find a company that can help do this. If they volunteer and file back taxes, it's likely they just have a penalty of 2,000 baht for late filing, plus 1.5% for any tax that was owed on top, rather than any punitive fines or further problems. So it's important that people can fix this, and it's important that people know that they've got that option, rather than, you know, they could potentially not get contacted at all. But the reality is, you know, the data is becoming pretty impressive, what they have on hand. And, you know, it's easier to fix the problem now than having a problem come to their door.
All right, so we're going to wrap that up. We want to thank Carl for providing us with a lot of information, a lot of simplification for what can often sound like a very complex topic. And if you're interested in contacting Carl or going to Expat Tax Advisors, we're going to leave a link in the description, and we're also going to leave a link to the full guide so that you have one resource. You can check out all the rules that are up to date for each given tax year and not rely on things like ChatGPT and YouTubers. So thank you so much, Carl, for your time.
No problem. Appreciate it. Thank you.